Hello everyone, my name is Bree Nichelle, and I will be speaking about Chapter 9, Learning Objective Number 2, Partnership Formations and Acquisitions of Partnership Interests, from pages 9.7 to 9.13. What to expect in this presentation: we will speak about a partner's holding period and a partnership interest. We'll then go into a partner's tax basis and holding period and contributed property. We'll then talk about the types of capital accounts, contributed services, and we'll briefly touch on organizational expenditures, startup costs, and syndication costs. In a partner's holding period and partnership interest, a partnership interest is considered a capital asset. Because of that, the partner's holding period in the interest determines if the gains or losses from the disposition of the partner's interest are either short-term or long-term capital gains or losses. The length of a partner's holding period for a partnership interest acquired by a contributed property depends on the nature of the assets the partner contributed. For instance, if a partner contributed a capital asset or 1231 asset, which is normally land, the holding period of the contributed property would tack on to the holding period of the partner's interest, or it would begin on the day the partnership interest was acquired or it was official that the person was now a partner. In a partnership tax basis and holding period and contributed property, partnerships must establish their inside tax basis in the contributed property, just like they would determine their outside basis in their partnership interest. To ensure built-in gains and losses on contributed property are ultimately recognized if partnerships sell contributed property. Partnerships generally take a basis in the property equal to contributing partner's basis in the property at the time of contribution. Partnership retains the holding period of contributed assets. Only the character of a contributed property does not carry over. However, the capital or ordinary gains or losses on disposition of a contributed property usually depends on the manner in which the partnership uses the contributed property. Going into capital assets, entities taxed as partnerships track their owner's equity using a capital account for each owner. And they can be tracked using the following methods: the GAAP capital accounts, there's tax capital accounts, or Section 704B capital accounts. The next slide we're going to talk about tax capital account and 704B capital account. But just to mention real quick, as we know, GAAP capital accounts is generally accepted accounting principles, probably used by most partnerships or so, and that would just reflect, of course, the more likely the book values of the capital accounts. The tax capital account, one of the reasons why a partnership may use a tax capital account, one, it does satisfy the bookkeeping requirements. It satisfies bookkeeping requirements as far as maintaining the books for tax accountants. It provides useful tax-related information such as calculating the inside basis with contributed property or soon to be with contributed property, Also, it is adjustable to add partner shares of earnings and losses, contributions, and distributions. In a Section 704B capital account, it's similar to a tax basis capital account. However, the only difference outside of that is that it reflects the fair market value of the contributed assets, which will then represents the true value of a partner's capital interest. So in the book, there is Exhibit 9.92 that shows a balance sheet of a one side of it being a tax basis capital account and a 704 fair market value capital account. And as you can see the differences. Of course, the cash reflects the same. However, the land basis, and this I think it was from previous example, the tax basis on the land was shown at $20,000, whereas the fair market value was shown as $150,000. So this just illustrates the difference in the partners' capital accounts and how to approach them. Going into contributed services, partners can receive partnership interest in exchange for services they provide to the partnership. Example, providing law services to the partnership. Companies provide their employees with partnership interest to reduce cash payments, for instance, regular payroll, for instance, and for their employees to act more like owners. This can create tax consequences to the contributing partner and the partnership, but that depends on the nature of the partnership interest received. So the two types of contributed services for partnerships, one of them will go into the capital interest. Partners who receive unrestricted capital interest in exchange for services have the right to receive a share of the partner's capital if it liquidates. It must treat the amount that they would receive as ordinary income if the partnership liquidated, which is also called the liquidation value. Tax basis of the service partner will equal the amount of the ordinary income he or she recognizes, and the holding period begins on the date he or she receives the capital interest. Depending on the nature of the services the partner provides, the partnership either deducts or capitalizes the value of the capital interest, and if this is deducted, the allocation is then given to the non-service partners, which are the partners not providing services. The other type of contributed services for partners may receive a profit interest. The upside benefit, economic benefit for the profit interest is that they provides the right to share in the future profits of the partnership. However, there is no liquidation value at the time that they are received. A lot of non-service partners prefer using this method, one, so that they don't have to give up their shares, and also if the partnership is unprofitable, they might not have to give up anything, because obviously if there's no profit, there's nothing to share. As a result, this is riskier for service partners to have profit interest over capital interest. To continue from there, since there is no immediate liquidation value with profit interest, service partners typically will not recognize income, and non-service partners will not be allocated deductions. Future profits and losses attributable to profit interest are allocated to the service partner as they are generated, and the partnership must adjust any debt allocations based on the profit and loss sharing ratios to reflect service partners' new or increased share of profit or losses. Alright, and going into organizational expenditures, startup costs, and syndication costs. These type of costs should be capitalized to benefit the partnership over the entire lifespan. Organizational expenditures are usually associated with legally forming a partnership, such as attorney and accountant fees. Syndication costs is to promote and to sell partnership interests, while startup costs that was incurred prior to the active trade or business would be included in this as well too. If the partnership does not capitalize, they can amortize organizational expenditures or startup costs only. Syndication costs are not deductible, so they would not be included in the amortization. So an overview of the presentation. Once again, we discussed the partner's holding period and partnership interest, partner's tax basis and holding period and contributed property. We talked about the capital accounts as far as GAAP, tax basis in Section 704B, the type of contributed services where a service partner may either receive capital interest or profit interest. And finally, we briefly touched on organization expenditures, startup costs, and syndication costs. Happy 4th of July, everyone, and you guys have a great rest of your weekend. Take care.